Lacani's high dividend equity strategy is a strategy built for insurance companies. It provides higher income, lower risk, and ideally over the full market cycle, beating returns. It began in 2011 as an offering as an alternative to index funds for our clients. And throughout history, our 15 years, it actually has met all of those goals. So we find high dividend equity to be very appropriate for insurance companies. It's important to remember that high dividend equity is particularly geared toward lower risk. And so typical insurance companies may have equity exposure, but it tends to be passive, exposed to the entire index. These days especially, that's more like a growth fund than a broad market index. So putting HDE in their portfolio will tend to lower the risk and raise the income of their overall equity investments. Insurers face a question today: where do they want their equity investments? Currently, the broader market, the S&P 500, looks more like a growth fund than a broad market index. Insurance companies don't need that kind of risk, in our opinion. They need to have a strategy that offers higher income and lower risk, as well as good returns over time, so that they essentially can meet their income needs that would not be met by a broader fund. So we think that either adding high dividend equity to their equity investments or replacing their current investments with high dividend equity makes particularly good sense at this time. Lacani advantages that we've had decades of investing in corporate bonds. So we have a very seasoned team of corporate credit analysts. We use those analysts to analyze equities as well. They're trying to determine whether these companies can maintain or grow their dividends over time, which we find to be prime targets to invest in high dividend equity. As far as we know, it's unique in terms of its approach to investing in high dividend stocks.